Ladies and gentlemen, welcome to Creating Tailwinds Podcast by Flight Path Financial with your hosts, John Urbick and Jared Adams. Join us today as we discuss the power of infinite banking. And here we go.
Welcome back, everybody. Another episode of Creating Tailwinds, the podcast with normally Jared and John, but we've got a special guest today, Mr. Glenn Yaney. Thanks for joining us. Thanks for being here. Always great to see your face, but thanks for taking the time and just getting together. How's your day going?
It's great, and thank you for having me on your podcast. Always great to talk to you. I feel very open book. I text you all the time with random IBC stuff, and
likewise,
you and I, we've kind of grown together just through nerding out through infinite banking concept.
Yes, that's right. Yeah, I mean, I was a new practitioner middle of last year. I believe you're a new practitioner as well, right? Like you just finished the course.
Yeah, definitely.
Huge congrats, man. Welcome to the community.
The whole Nelson Nash Institute, it's like when they start getting into this Austrian economics, at the beginning, I was like, well, why am I reading anything about this? And the more you get into it, the more of it does. And I would always hear, like I've heard about IBC for a long period of time. And they would always talk about these Austrian things that are going on. And I'm like, what a waste of time to think about, But the more I read into it, the more pure I believe infinite banking concept has become and how it's really, really helping the common man. And that's really my vision and goal is just to bring people out of the dark of relying on the banking system and also having more ownership in their life.
I love what you said there. When I nerd out on the Austrian side, I end up in kind of a 3 bullet point conclusion, which is, end the Fed and end fractional reserve banking, bring back the gold standard, but then don't do business with banks. I can only control one of those. I'm not a congressman. I'm not a senator. I have no power other than who I elect in terms of those other two things happen. But I do have control over that one. Boy, do I run with that one as hard as I can. I couldn't agree with you more. Like it's a fun journey to nerd out on the Austrian side.
Yeah.
But I get down that rabbit hole and I go, wow, this is some stuff.
Yeah. And really, we were talking about it before the podcast. It's really a pretty boring asset, but it's I think it's definitely very well thought out and crazy. The whole structure of life insurance and how it was before even the tax system was even created.
Yep.
And how it still
how
applies
they can't
today.
Find money out of thin air.
Yeah.
Whenever they give you a policy loan from what you're borrowing from a future death benefit, when you're looking at that, they can't create that money out of thin air. The insurance company has to come up with that money somewhere. Whereas if you go to the Bank of Main Street and borrow money, they can just create it out of thin air. They don't even have to have reserves anymore.
Yeah, definitely.
Yeah. Crazy. Well, I love what you're talking about as well with just the mission to help. How do you see this as the vehicle, but also your ability to, you said before we started, if I can help one person, I feel like I've changed the world in just enough way to make a difference, right? Like I completely agree with what you're saying with there. And I'm fully on board with that. Like, how do you view IBC as that vehicle?
Yeah. So we kind of talked about it before also, I got sober from, I've never talked about this online, so this will be the first, but I've got
we can edit it out if we have to.
Oh, that's all good. I got sober from alcohol about 15 years ago. And I believe I found my higher power through doing that. Very difficult. It was very difficult.
Yes.
And what I have found is the way that I get a fulfillment and also am able to get better through helping other people stay sober. So, and I think that what we've done with the infinite banking is like, we're just trying to get people to see that you don't need the banking system, or if you're going to use the banking system, you use them on your terms. And I can tell you, I have about 650 units of real estate, and I've been working on the bank's terms. Every deal comes down to whether the bank says yes or no. And then when things don't go the way that you'd like them to on the spreadsheet. It turns into sleepless nights. You're trying to figure out how to make sure that you're able to pay these debt payments, or if you're able to, create cash flow, through, just selling assets. You find yourself like selling a property that has a lot of equity, which probably means it's one of your better assets that you own. And you find yourself selling those assets at like not exactly the best times. I mean, right now is not the best time to be selling real estate. It's the best time to be buying real estate. So find yourself finding the property with the most equity, and instead of having a place to capture your equity, which would be a properly structured whole life policy, you're tapping into the real estate that is paying the bills. So, we've sold a few. It's not a terrible thing. It's kind of like you're cleaning out the inventory to go and buy more real estate. But at the same time, we're trying to build out a runway of control and ownership of all of your assets. That's why just to go a little bit further into it, I can tell you that I became financially independent by deciding not to put money in my 401k. And I drank the Kool-Aid. I put about $56,000 a year into qualified retirement plans. And my wife was going to work for 2 years without receiving a paycheck. I was so sold on the idea that she needed to put her money in a 401k. So her pay wasn't very high, but at the same time, 100% of it went into her 401k. She maxed out her 401k. I maxed out my 401k. We maxed out our HSAs. We maxed out our IRAs, Roth IRAs, whatever it was that year. Yep. And we didn't, my goal was to save as much as I could of my income. So it was like I was saving 50%, if not more, of my income into these traditional retirement plans. But then on my days off, I would hang out with people that were financially independent, owning real estate. So I'm watching these guys be successful buying real estate. And what happened was I would try to explain to them what I'm doing with my 401ks, and they would just nod their head and like, that's really great. Good that you're doing that. And I would ask them like, what are they investing in? What are they doing? They're like, I only buy real estate. And it's like, and I'm not saying that everybody should be that person that only buys real estate, but we all have our business. We all have that business that we're in and that we understand. And I think that's what IBC encourages, is like, let's just focus on building our own business and ownership. And that's what I decided to do around 2018, 19 timeframe. I just stopped putting money in my 401k. I don't care about the match.
Yep.
I can tell you, this is why I don't care about the match, okay? Not financial advice, but I have a goal to become financially independent. And if there's something that's dragging down my chances of becoming financially independent in the short term, the 401k is not going to matter when I'm 65, because my goal is to not have to pay. Like, what we're doing in our 401k is we're deferring our taxes to probably pay higher taxes. And when I think about what I'm doing with my dollars, it's actually, in my opinion, a self-fulfilling prophecy that if I'm planning to make less money when I'm 65, I will probably make less money when I'm 65. So my goal is to make a lot more money than I'm making today than I am when I'm, So my goal, my income's supposed to grow throughout my whole life, but I don't want it to go down when I'm 65 to save money on taxes. So I don't plan to make less money in the future. So my plan is to not put money in my 401k. It took me about 1.5 years to really focus on buying cash flowing assets to become financially independent. So anyways, I'll let you go from there.
No, I love that. I absolutely love that. What a cool description of how that applies in your life. I mean, there's one example of that, but then it's so much deeper, right? It goes so much further. It's not just, that really helps me in the mindset of, it's not a product, it's a process.
Yes.
Right? Anybody can go buy a whole life insurance product. But if you're working with a practitioner and you are thinking about this through the process of infinite banking concepts, you really have altered your future. And it's because it's all about how you're thinking about where it's going and how it's operating and how every dollar is functioning for you and your family. And you said it perfect. I didn't care about that, that match, right? In an aviation term, we would call that parasitic drag. You get those little rivets on the airplane or just the bumps and changes on the plane, right? That's parasitic drag. That's something you can't control, but it's there and it's slowing you down. Now, if you're saving money in a qualified plan, you're still going to get to see that money eventually. But what about all the drag that's caused on you in the lifetime that you've had that? How did you access that capital? Were you able to do anything with it while it sat there, which is the loss of control? So that resonates huge with me. I couldn't agree with you more.
Also, if we're trying to take back ownership of our life, I really believe, just like what you're talking about, we're trying to take away every type of thing that's stopping us from doing that. So if I'm taking back control of my life, I can't do two things at one time. So I can't give my money to Wall Street and try to take back my money, try to take back my ownership, because I'm giving Wall Street the ownership of my capital. So I have to look at my capital and really give myself the confidence to go out and take the risks. And just to go a little bit further into risks and how I changed, I used to be super risk adverse. Like I was paying down my house. I was paying, my 2% interest rate mortgage. And, but I thought I actually did it. And I believe it was better than putting my money in a 401k because I still had access to it in a sooner date. But anyway, so what I can tell you is that when cash flow starts entering into your system, like my first time I got a check, it was about, I don't know, $300 to $500 for a piece of real estate that I owned. And then, which didn't really change much. And then something happened. I think I got a lower rate but my new cash flow was $1,000. I know what I did. I paid down my 2% mortgage to get it to $500 a month. But in return, the rental was paying me $2,000 a month. So we'll just say that the overall expenses was $1,000 and my cash flow was $1,000. My mind started changing then. It was like, this $1,000 can go towards majority of my mortgage now. Like almost most of my mortgage is paid for through this other piece of real estate. And then what I did after that is I bought a 3-unit mobile home park and then a 9-unit mobile home park. And when I did that, it pretty much made me financially independent. And if you looked at risks, my risk tolerance shifted immediately. Like it was like, no longer do I have to rely on my own income and I have other assets. So it's like I'm making about $150,000 a year at my old job. And I knew that $150,000 was going to the next asset. And,
Yes.
when that starts to happen, it will look risky to somebody that has no cash flow. But when you have cash flow in your system, you are able to take bigger swings is what ends up happening.
Yep. Wow. I love that. That also kind of reminds me of the idea of just the order of operations. If you're cycling your cash flow through a product you control first, you literally have control over it. You're the one that decides where it goes, as opposed to if you're cycling it through other debt products or somebody else's bank, you don't necessarily have control. Just like you were saying earlier, you might up in a spot where you've got to sell something you didn't want to, or, a whole variety of things that can come up. So if it's something you control, is that your financial setup, right? If, someone else is listening to this going, wow, that's totally different. I didn't even know that was an option. Yeah, that's an option. Like take control over the banking function of your house, of your business, because if you're in control, you say where it goes. Nelson would say that you should be really good at 2 jobs, whatever industry you're in, and banking, right? You should be really, really good at both of those. It doesn't have to be a full-time banker, but make sure you have access to your capital.
So if we could, I've actually never done this, but
Sure.
if we could just look at my personal story and think about how IBC could have actually made it better and really. So I bought a house.
Yep.
I
How long
paid it
ago is this?
down.
We're talking 10, 15 years?
So I bought this house in, we'll say 2017. It wasn't, yeah. So I guess, yeah, about 10, crazy. It's about 9 years ago. So
And
I bought this house.
we completely skipped over any type of intro. You're in Florida, in the Tampa area, right?
Yep. Tampa,
Okay.
Florida.
Yep.
I'm an owner operator of real estate. I manage 650 units, and I've worked in real estate for over 17 years. So with this, so this whole time I'm trying to become financially independent. I don't know how to
Yes.
do it. I'm too freaked out. I don't want to do these deals. And I understand when anybody feels stressed out because it is stressful. So what I did was I thought if I could just get my mortgage down to $500 a month, I'd be able to survive better. Like I'd be able to, like I could go back to Red Lobster when one of my first jobs, and I could
Yep.
go work there and survive with a $500 mortgage. What I what I ended up doing, but if we would have done if I would have started an IBC policy, I would have been able to have $100,000 equity in my policy, and that $100,000 equity would have made me look at that house before I decided to sell it later, or see how that house would be more efficiently used. So I still have debt, very efficient debt, 2.7% on a 500, and I think the mortgage at the time was like 1,100 whenever I had
Mhm.
it. So that
Sure.
$1,100 mortgage would have just stayed there, and my tenant would still be paying me $2,000, but I'd have $100,000 liquidity in my actual policy. So now I have the 100,000 and I have the asset. Now I decided to move into a new house down the street, a little bit bigger house, has a garage, whatever, a little bit of lifestyle inflation. But I have we'll say the $800 a month cash flow from the real estate, or we'll say 500. We'll just say 500 after expenses. So $500 cash flow. I have an asset, which is a depreciating asset that gives me tax benefits. Now I have my personal residence, and I have this $100,000 available to be able to take opportunities. And I would have been in the same position that if I were to pay down my mortgage. And also I'm in a totally better position is what it comes down to. That 100,000 is growing at a consistent, guaranteed rate, whatever, 3 to 5%. And we're able to make more calculated decisions. And to buy those two mobile home parks, it cost me about $10,000 for one, and about 25,000 for the other. And I would have still became financially independent through all of that. But I would have had $100,000, or well, I would say at the end of it, I would have had $50,000 cash compared to being completely liquid, where I had to sell assets to be able to keep buying more real estate. Or you're pivoting. When you buy a single family home, you eventually buy a bigger asset, eventually keep growing. And with infinite banking, it kind of keeps you honest with your capital. It's growing at a solid rate on your cash that's available, and you're able to make more educated decisions. And that's what would have happened if I would have started it then.
Wow. What a cool story, man. I really love that. That's a real case study on how that could have applied to you on the sequence of operations, right? Had you sequenced it through that first, you still would have taken advantage of the same opportunities, but what you had to show for it afterwards. And when you do that over and over and over again over the course of 5, 10, 20, 40 years, what's the difference at the end of that? That's where, this is just my own personal opinion, that's where a lot of folks get caught up on a return. What's my return when I put my money into this policy? Okay, cool. Yeah. Like, are you considering all of the things that are possibly showing return? Like, the best description I heard that I really liked was there's an internal rate of return, an external rate of return, and an eternal rate of return. Like, you're getting a 3 to 5% that's likely inside of a policy, but you can also deploy those funds outside. But when you deploy that, are you buying real estate? Are you putting it in the market? Well, you get to pick. It's infinite options. Where are you deploying that? And then at the end of a whole life policy, whenever you do graduate, there's a death benefit that passes as well. When you include all of those three, okay, now you can accurately look at what a rate of return is. But if you don't include all those three, it's apples to oranges. And a lot of folks struggle with that, which is, I think, it's just a standard part of that industry.
Definitely. And I can tell you that so I watch a lot of IBC stuff, and I see a lot of people talking about returns and stuff like that. And like which policy, which company is going to be paying better returns or whatever. It's all a trade-off. But what I would say is the people that I know that are most successful, they don't make money in a spreadsheet. What I'll say is if you have to go into a spreadsheet and try to really drill down to figure out exactly your percentage of what you're going to make, I don't think it's a great deal. And that's what Charlie Munger and Warren Buffett would say. This is a back of the napkin math that we're just creating liquidity to be able to take advantage of opportunities. And it's like crazy. As I'm thinking about my own story, I'm just, because I always thought is like, would it really have helped? And as we're talking about it is like 100%. And what ended up happening, just to give a little bit more context with that story, because I got a home equity line of credit on my primary on that rental that I paid $100,000 down, and I got $90,000 borrowed against it to renovate the second house, and I got freaked out. I got that 90,000. It was scary, and the structure and just so what I
Variable rate.
learned is that I ended up cashing out an IRA right before COVID, and I got lucky and by them not charging the penalty. But then they also said it was you can spread out the taxes over 3 years. But I pulled it out right before COVID, like before it even was an issue. But I got lucky. But I pulled 90,000 out of my IRA because I realized the IRA wasn't going to do anything for me. But if I put that 90,000 into the IRA or into the pay off that line of credit, it would give me more opportunity to buy more real estate. And so if we could, I'll tell you a little bit more about the IRA thing, because I had about $300,000 in my 401k. And as I left my job, which you would call the very risky spot, you have the income, you have $100,000 cash in your bank account, and I leave my job with literally just a plan to make $1,500 a month from this new venture that I'm deciding to take on. But I had this $300,000 in my 401k IRA, in my wife's and mine. And what I learned about, and this is what happens when you get into your own business and you become an owner of a business and your situation, is that I learned about depreciation and the benefits that it has on real estate professionals. So I had about $300,000 and I started pulling about $100,000 a year out. It was pretty much $100,000 a year, and I would put it towards a new deal. And the way that we would offset the taxes is we would do like a cost seg study, which right now this isn't tax advice, but they're about 100,000. They're at 100% accelerated depreciation. Definitely talk to your accountant about it. And,
Yes.
and you have to be a real estate professional. So qualify, there's more to that. Just look it up. But anyway, so I took that 100,000 and I actually was able to get it tax free out. I paid the penalty, but I paid 10% of the penalty to get over 100% on that penalty. The 10,000 that I paid on the penalty, I was able to get $12,000 of annual income going forward, which kind of gave me more breathing room to leave my job. Like I had this $300,000. I eventually rolled it all into about a 12 to 15% income on my real estate. And I boosted my income by like $3,000 to $5,000 a month. And that made it to where I could survive even more. But I figured out that once you become the owner, you're able to take these tax benefits that the government creates for people to be able to build on their system. And it's like, this is why I'm so against the 401k, because the more I started unwinding out of it, the more I realized the government or the 401k is meant to hold you to your job. And once I figured out how to unwind it, it was how I started learning how to further accelerate my career, and my income really went up after that.
Man, that's super cool. What a great story. I appreciate you sharing that. And so even though real estate is still a very primary function of what you're doing right now, you've also done IBC policies for your family, but then helping folks Discover IBC. That's become a new, fun, challenging path as well, and rewarding, right? Every single time you get to help somebody out, you're helping set their future and change their future outlook, whether it's for this generation or the next. Have you had any clients that have come back to you afterwards and just said, man, I can't believe I didn't find out about this earlier. Thank you.
Yeah. So I'll tell you that I'm very new in the process. I've done about one policy, but this kind of goes back to like, thankfully I have real estate income. I feel very compelled to teach people about infinite banking.
Yeah.
And it's a very simple product, actually. It's like our minds can't wrap around it because we've been taught our whole lives to do it a certain way. Like the 401k is a safe way, which is not. It creates illiquidity in your life, and give your money to somebody else. Even in this situation is like, if you have $50,000, you can give it to a real estate syndicator or something like that. And I think that that's the wrong idea. I actually believe the people I look to raise capital from is generally the people that are in they're over 500,000 to $1 million a year income. And the reality is because they have extra income, because they have extra side funds to continue to grow their own business. But if you are in the $100,000 to $300,000 income range,
Yep.
I believe that the best place where you can take your capital is invested in yourself. And that's kind of what I started doing, because with my podcast, my first podcast was Millionaire Journey, and I interviewed 100 real estate syndicators, and they're all good people. Most of them were good people. I didn't really see too many bad characters, is what you would think. But at the same time, it's like I just started seeing that I don't know if this is the right play for most people, and really who's benefiting out of this podcast. I mean, I thought it was more of a commercial for real estate syndicators to find capital, but I don't know if I found somebody that came to me and they had like $100,000 in their bank account, and they wanted to give me 50,000, I'd be like, hey, why don't you try to figure something out? Like, I would want to like drill down on what they're doing personally on their own
Yes.
stuff. And I
Yep.
think that's with IBC, that's what we're doing here. We're like looking to like figure out how to make your system a little bit more efficient and while protecting the downside. So it's like, I don't want to take anybody's money that needs it later.
That's
It's like
right.
the people that give us capital they're understanding it's a 5 to 7 to 10-year plan that they're committing to. But I want somebody to live their best life. And that's why I believe infinite banking is good for really everyone that has a little bit of discipline.
Yes. Yep. That's spot on. And you mentioned that you had a podcast that was previous. It was the Millionaire Mindset. You did a bit of a rebranding on that. Did you change it up and you've got something different going on right now?
Yeah, so I did. Yeah, Millionaire Journey was the old podcast.
Millionaire Journey.
I didn't mean to do this, but I stopped it at like episode 100. And then I pivoted to Capitalizing Your Life podcast. And with Capitalizing Your Life podcast, it's very similar to this one. We talk to, practitioners, Nelson Nash practitioners or infinite banking practitioners. And I also like to go through my way of thinking through really just investing back into yourself. Even the people that we're trying to fix $1 million problems. And I think even the people that are, you know, I believe if you're making $100,000 a year, you have a $900,000 problem right now. You're losing $900,000 a year in income, because we're all trying to make $1 million a year. And when we make $1 million a year, we can really help other people. And how do we do that? At that 900,000, that $900,000 is ignorance tax. You're losing $900,000 of income. I could tell you just one last thing is I have a friend. This is a great story. He was making $500,000 a year, and he lost his job, and his job was paying him $500,000 a year. And I was like, oh my God, that's got to be scary. How are you going to find another $500,000 a year job? And he found the job within 3 months later. And you know why? Is because he has the education to get the $500,000 a year income. And I think as long as we're focusing on ourselves, we're going to get to that goal if we take every penny that we can to invest in ourselves, education, whether we're buying real estate or like the real estate is an educational program of what not to do. Yep. But at the same time, buying cash flowing assets or even educational, classes. I wouldn't say college would be the answer. I would say more of like a niche education. And those niche educations are not that much. Like you hear that these guys, this one guy was talking about a rent to own program where you teach yourself how to like create a rent to own portfolio of single family homes. And it was $1,000 for the class. And I was like, that's it. I was like, you figure this out and you can freaking build out this $20,000 a month income, and that's what we're talking about. Like, I'm not saying that I can tell you where to go or how to do it, but I think it's a soul searching thing that you have to be able to willing to teach yourself to where to go, and that's what I try to encourage everyone.
It's funny to hear you say the 10 and the 90, because I know those are kind of arbitrary numbers, but I heard a different 10 and a 90 recently that basically said, as someone who is honored to give 10% to our local, church and organization, the question was, what are you doing with the other 90? Are you a good steward of the other 90? And I know that's a completely different change from what you were saying, but just hearing that number reminded me of that recently. I really like that.
Yeah. I mean, it comes down to also with that 90% that we're talking about, that you're talking about, is like, how are you improving your family dynamics? Like, are you showing like,
is it going to the bank? Is it going to bills? Is it going to interest? Like, where's it all going?
Are you investing in your children, investing in your education, like all these things that come up? And I can tell you, I've been in some masterminds. Like I'm in this mastermind right now. It's like a house flipping mastermind, and I don't flip houses at all. And I went into it, but I learned so much. It was like $4,000 a year. And I can tell you, I was able to make hundreds of thousands of dollars from just going into these masterminds and then just getting a little nugget from one person. That 4,000 pretty much was paid for immediately. And I think it's all in where you're at. Like if you're just getting started, you might not go into this type of mastermind. But if you're like, I'm trying to work towards the ones that are actually, they're looking at tax returns and stuff right now. So it's kind of like, these are the masterminds I'm working on getting into, because I'm like, I'm not too concerned with selling a policy. I think I'm just more excited about being around people that are in a different level than I am, or in the same level, if not higher, and just try to see what they're doing better. That's what conferences and all kinds of stuff are good for.
That's so cool. That's really well said, man. Well, thanks again for getting together. Always great to see you. I know we'll keep the texts and conversations going, but whenever this makes it out to the air, I'm completely honored to have you on board, man. So thanks for
having me, Jared.
Cheers, man. Have a great day.
We'd like to thank you for tuning in to today's episode of Creating Tailwinds podcast with your hosts, John and Jared. As always, we welcome your questions and critiques. You can reach us through the Contact Us tab at flightpathfinancial.com. Remember, it's all about how you think. As Nelson Nash has said about infinite banking, give it your close attention, and it can make a radical improvement in your financial future.